Welcome everyone to the license study session. For today we're going to cover policy provisions and riders. This is a also important topic that gets a lot of coverage in the exam as well. So what do we need to know from here is that premium must be paid for the insurance company to pay benefits, right? So a premium can be paid monthly, quarterly, semi-annually, and annually. A premium mode is what we call it. And outside of these four, it can ask you which of the following is a premium mode for life insurance. Weekly is not an option. Bi-weekly is not an option. So you have to see monthly, quarterly, semi-annually, and annually, right? And then of all these four, the higher the frequency, which is the monthly, is the more expensive. The least the frequency is the annually, which is least expensive. So more expensive on the monthly, less expensive on the annually, right? The other thing that you need to know from here is a free look period. The free look period will allow you to get the policy, right? Once the policy is delivered, and then you can have a look at it, and then you can say, I don't want it, right? So you get a full refund of the premium because the premium is taken upon the policy approval, and then the policy is printed and sent to the insured. So now when you get it, you have about 10 days. In most states, California have, if somebody is over 60, it's 30 days. But that counts from the policy delivery date. Policy delivery date. So when does a free look period start? From the policy delivery date. Right? Grace period is a period that you have not paid the premium, and then the policy is still in force. So the policy is still good, the premium is not paid. Grace period is 30 days. You have 30 days to pay the premium, and then the policy is still forced. What happens when this happens during grace period? This benefit will be paid because still the policy is in force. But minus the premium unpaid, right? So minus the premium, this benefit will be paid. But if the premium is not paid, the grace period ended, the policy lapsed. You have no more life insurance policy. And then to get it back to life, you have to reinstate the policy. At that time, you have to provide proof of insurability and past due premium. What do you need for reinstatement of an insurance policy? Those two are a requirement to pay past due premium and proof of insurability. Why do you benefit from reinstatement? Because the premium are at a lower age, right? Versus if you just apply for a new one, will be higher premium. Usually the reinstatement period is very generous. It's about 3 years. You have 3 years to reinstate, pay past due premium, and then if you are insurable, and then that policy is back to life, right? Reinstatement can happen within 45 days after application submission. So you need to remember the 45 days, you need to remember the 3 years, you also need to remember proof of insurability and past due premium for reinstatement. Dividends are paid to policy owners by mutual companies. So mutual companies are participating companies, they pay dividends. What's a dividend, right? A dividend is a return of excess premium, right? And not taxable. So it's a return of excess premium, not taxable, right? It can give you an option, fully taxable, taxed at capital gain tax, right? But it's not taxable. The answer is not taxable. Policy dividends are not taxable. Why are policy dividends not taxable? That's one of the questions that you might see, because they are considered a return of premium. A premium is after tax money that you put in your bank, and then from the bank goes to life insurance. So since you pay taxes on that, it's considered a return of premium. Now it's not taxable, right? Dividend option is selected by the insured at the time of policy purchase. So dividend option is selected at the time of purchase. So that's a good point to remember. What's a dividend option? Dividend option for policy owner as when receiving dividend payments from the insurance company. How do you want to receive the dividends from the insurance company? By the way, dividends are never guaranteed in life insurance, so that might appear in the exam. Just remember, dividends are never guaranteed, right? But if they come, you have the options how to receive them, right? Dividend options include, you can receive them as cash dividends. So you want to receive them as cash, you just take it out, you cash it out, right? Or you can use them to reduce the premium payment for the policy, right? So they can offset the premium from that. So that's the second option that people have. Or you can leave them with the insurance company to accumulate interest. It's called accumulation at interest option for the dividend. All of these are dividend options, right? The policy owner leaves dividends with the insurer to accumulate interest, which is taxable also. You need to remember, accumulation at interest is taxable. The return of premium or a dividend by itself is not taxable, but if you leave it with the insurance company, now it accumulates interest, the interest is taxable. And it's taxable the year it was received as well, right? Paid up permanent addition option. So you can get a permanent insurance and add to that, right? Purchase additional permanent whole life insurance with that. Or you can also purchase 1 year term option. A 1 year term option because dividends mature every year. So that's the option that you have. And then you can allow the policy to exchange the dividends for a 1 year term policy, right? Now let's see some questions that might appear here. Which of this is not a valid policy dividend option? So having all this knowledge and putting all 5 together gonna help you to see that, right? Reduced premium, paid up addition, monthly income payment. So the exception is what it's asking you. Always pay attention because they love the questions not or except at the end. So if you see that, right, it's asking you for which is not an option. So reduced premium, we saw that. And then paid up addition, we saw that, right, for permanent. And then also you can say accumulation at interest, but a monthly income payment is not an option for dividend because dividend mature yearly, right? So the company is releasing, they are doing their finances every year. So a dividend is released every year. So you cannot have a monthly income payment from a dividend option. So it's very good to see that all these 5 together. Now, if a question like this comes in, you have to put all of them, right? You can answer that. Which of this does a policy owner not have the right to change? So policy owner can change different things, right? Can a policy owner change the premium mode? Yes, you can change it from monthly to yearly, right? Can you change a dividend option? Yes, you can change a dividend option, cash dividend, and then the next you want to use it to offset the premium, or you can leave it with the insurance company to accumulate at interest. Yes, you can change a dividend option as well. A dividend schedule, can you change it to monthly? No, you cannot, right? Because it's yearly. So the schedule cannot be changed by the policy owner. This is a very good question. A lot of people miss it. So beneficiary you can change, right? The owner can change beneficiary as well. A dividend option is something that the policy owner cannot change, right? Additional sample questions. Which life insurance policy provision permits policy owner to exchange beneficiary designation? So which one will allow you to do beneficiary designation, right? The entire contract clause, assignment clause, insuring clause, ownership clause, right? So now it's talking about the owner to change beneficiary designation. That's an ownership clause allowing that to happen. So you have the ownership, you can change beneficiary, right? And insured cannot be changed as well, right? And insured cannot be changed. If an insurer changes, it's a new application for life insurance, but you can change beneficiary, and that's the ownership clause. Which life insurance dividend option can create a taxable income to the policy owner in the year that the dividend is paid? So I want you to pay attention. Just we can answer the question, but so which one will allow you? Accumulation at interest, paid up addition, 1-year term option, and then the answer is accumulation at interest, right? So accumulation at interest is giving you a taxable income. So the interest is taxable, and it's taxable in the year that the dividend is paid, right? So in the year, because it's accumulation at interest. So these are some good concepts. I hope you find that helpful. Please subscribe, share, and like, and see you in another video.